So no trade is foolproof. Yes, this is a great trade. People who are preaching it that it's a great trade on YouTube. I'm not trying to say they're being disingenuous. It's a good trade, but is it risk involved in it? Absolutely. I'm going to jump in and talk about this 112 really quickly. So let's just say we were going to go to we're going to go to 63 days out. Some of the people on the YouTube channels they would do 30 to 60, but a lot of them are going even further away because you get better buying power, especially when you have portfolio margin or you're using span margin, which is options on futures. You can get really far away. I'm showing it on SPY just for right now because it's going to be able to show on the curve view better. So anyway, when you're doing a 112, you're buying a put spread first, right? And so at the Dorian Trader, we normally would buy this at or near the 30 delta. Okay. And so some people say 25 points wide, some people say, whatever, right? But just it's a put spread. So this is the bear part. As you can see here, that we're paying 277, we can make $1,600 on the bear part if this is the only thing we're gonna do. So that's the one there. So because you're buying, let me show you this. You're buying one here and you're selling one here. And then you're gonna go down here and you're gonna do two. And normally they're gonna do it somewhere around a 5 delta. If you can go further away, then great. But I just said we're gonna do it at a 5 delta. So in this example, if we were going to sell this at a 5, and we can even just pick this 5, and then we're gonna do two here, and so in this example here, this is still going to be a debit, so this wouldn't work for us at the 5 delta on the SPY because you need it to be a credit. And so let's just say we went to the 8 delta here, so this will be a credit here, and so you got $95. So if we go to the curve view really quickly, and this is all right. So then I'm going to hit analysis, and so this is a bullish trade, Lisa, and everyone on the call. It starts off with a delta of 3.26 here. That's bullish, positive delta. And you can see that this is the at the money line here. And if it goes up, you're going to win this $92, $94 100% of the time if it just goes up and stays up. And if you wait to expiration, you're going to win the $92 100% of the time. If it drops, and this is where people go, they mistakenly think that, okay, you want this to go down because you can make more if it goes down. As you can see, right, you can make almost 2,000 here, just under 2,000 there, instead of $95 if it goes down. But this is a bullish trade. You really don't want it to go down. But if it does go down, you don't want it to go down in a fast way, because if it goes down too fast, then it's going to put pressure on these two kind of naked puts that you have, right? And so, but if it doesn't go down too fast and it lands in between these two short strikes, then that's where you can make that $2,000, right? If it lands anything above the 495 and in between the 420, the 520 here, you can make that 2,000 at expiration. But when the market is falling, these naked puts could, the volatility or the requirement to hold it could expand. It could increase a significant amount. Usually, Lisa, and this is why I'm saying that your simulated trading, your paper trading on Thinkorswim was off. It's usually not going to increase by 1,000% or something. It's just usually not going to do that. So for example purposes, right now they're saying I need $10,000 to hold this. Well, it most likely, when things get crazy, this could go to 30,000. But most likely it's going to the worst case scenario is going to go to 20,000 that you have to hold that, and so it's going to double, right? Double to triple the price. It's not going to go usually more than that. If it's showing more than that, it's only way it's going to go more than that if the market keeps falling a ton, and you get closer and closer to at the money. But this is the kind of misnomer, or the problem with this trade is that this trade will work a ton of times. Nothing's 100% of the time, but you can see this got a 98% chance of winning something. Well, most of the time the market is not going to fall that far. If this is a 5 delta or 3 delta or whatever it is, it's not going to fall that far. But if if it does, and you can get hit, or if it is falling too fast, you can get hit, because the value of these puts are going to outpace the bear part of this put spread. And so your trade can be down a lot, and your P&L can look bad, even though your deltas are still good. You can even still be in the green zone, and just your P&L looks horrible. And some people who had what we call the bullish bear on, they noticed that same thing, right? Or if some people had on something naked that was originally on the one delta, I know Ranjit did, and the P&L looked absolutely horrible. But I told him and told others, if you can hold the trade, if everything is still fine with your buying power, then just let it play out. You're super far away still. You're going to most likely win on the trade. The only thing that's going to really make you get out of the trade is your buying power. And if you can hold on, then you'll be fine. So that's why you can't just put these trades on and just because the buying power looks great, you can't just be throwing on a bunch of it. So for example purposes, let's go to the ES here, and let's go out a little further. Let's say we're going to go 91 days, just for example purposes. And let's just say we're going to buy at or near 30 delta. And so for me, I like to do stuff that's no wider than 5 points when you're doing the bullish bear, but I just say we do a 25 point wide here, and then we go down. That's the 30. Then we go down to let's just say we go down to a 4 delta here, and we sell 2 of these. And so you can see that we're getting $1,000, right? $1,000 in premium. And the most we can lose is if the index goes to 0. It's not going to go to 0, but the max we can make is 2250, very similar to what we were just showing with the SPY, right? But look at this buying power. This buying power is only 5,000. So let's just say you had a $100,000 account. Well, you can get silly and think that you can make so much more by putting more contracts on, putting more contracts. So maybe, putting on, instead of 1 round of these, you put on 4 round of these. Well, if the volatility spikes, this right here, like I was saying earlier, can go to 10,000 or 15,000. It can easily do that, even though it's still in the green zone. It's rare that we're gonna have a volatility spike the way we did when the volatility went over 100 points in one day and we're at that 50 strike. But if we did have it and you had these positions on, it's going to be super painful. So I tell people, don't get ridiculous with this, because even though your probabilities are super high, doesn't mean you're going to be able to stay in that trade, right? First of all, it can go down to a 4 delta. I've played these trades for years, you guys. This is the type of stuff I did in my hedge fund for a decade, and then way before then, the market can drop to a 5 delta. And as it gets closer to that 5 delta, the more painful it gets to hold that trade. And so if you don't have the buying power, you get kicked out of it. But if you do have the buying power, it's still going to be painful, because it could go past your 5 delta. It does do it. And it doesn't have to be a financial crisis for the market to drop past your 5 delta. It does not have to be that way. If you put this trade on for 91 days, and let's say this right here is 10% away, well, can the market drop 10% in 90 days? Absolutely, right? Obviously, it can drop to 10% a lot faster than that, but in 90 days, that would be a nice little slow drop, in my opinion, if it dropped 10% in 90 days. That's what we want. But if volatility is low when you put this trade on, well, you're probably 10% away. So as it gets closer, this is going to become a problem. So no trade is foolproof. Yes, this is a great trade. People who are preaching it that it's a great trade on YouTube, I'm not trying to say they're being disingenuous. It's a good trade, but is it risk involved in it? Absolutely. So don't go crazy with any trade. You want to stay small. If you stay small, you're going to be able to weather almost everything that happens. If you get too big and the market goes crazy outside of a range that's not normal, you're going to be kicked out of your trade. The broker's firm going to send you a margin call. You're going to get out of that trade way before it's a real problem delta wise. And that's frustrating, but been there, done that. And so I try to tell members to avoid the things, right? Learn from the mistakes I've made And that's why we want members showing their accounts, doing their issues. Sometimes we have too much of that, but it's just still a way to accelerate the learning process. So when you see people sharing their account or dealing with a problem, try not to be like, oh man, I have to hear someone else's problem. Think about it as time to think about what you would do in that scenario. And then because you're getting more occurrences, that's the more occurrences you have, the more experience you have, the better, right? Sir. So,
I posted, so I guess we haven't talked, but yeah, I've been doing some of these 112 type trades, and I posted in the bread and butter forum some
mm-hmm,
of my I've been doing these on mostly some commodities like gold and silver and that kind of stuff.
mm-hmm,
And yeah, I I like the trade. Dipping,
mm-hmm,
dipping my hands in it. I'm buying at around the 30 delta, and then I'm
mm-hmm,
selling the 25 delta as my like protective thing there. So
mm-hmm.
that 112 call at the bottom. So I've been in this
Okay.
trade now. I go out a long ways. Like you can see on the right end of the column, I've been in this trade like 100 some days or something like that.
Mm-hmm, mm-hmm,
Um, and you see the four naked calls at the very bottom line there.
mm-hmm,
The very bottom, yeah. And then they got the two protective, the put spread in front of it kind of deal.
mm-hmm.
Yeah. So I sell my nakeds at around the 7 delta, and then I buy that 30 delta is the thing I buy, and then I'll sell the 25-ish delta for the put spread that I'm buying in front of it for protection.
Okay. All right. So in this scenario, it looks like you did a 112 on the call side, and that's why you call it
Yeah,
112 call. So he bought the
correct.
call spread, everyone,
Yep.
and then he sold four naked calls, and he's doing this
That's
on
GC
gold.
gold.
Yeah, he's
Hmm.
doing this on gold right here. So this is same thing. You just flipped it, right? But you want to
Hmm.
go out far. This is what people
Hmm.
say about this trade, because you're gonna get so much better buying power with it, and then the move's gonna have to be so much greater for it
Correct.
to have an issue. So, and gold has been going up, you guys, since you've been in this trade, and
Hmm.
but you're still up 20% right now, or if this is current, and you're still really far away on that call side there at the 28.50, because it's
And
trading at
yeah,
25.19 or
right. And
something
you can
like that.
see, yeah, you can see the debit spread is actually profitable. You see that? Because
Yeah.
the 2560 has gone because it's starting to get kind of close, relative speaking, I guess.
Hmm.
So if you look at the P&L on the debit spread, it can
Hmm.
get profitable and you still be profitable on my longs, the nakeds.